Hi everyone. So we are now just over 1 hour into the US session. I'm here looking at the S&P 500 E-mini S&P June contract, and I'm just trying to get an understanding if this rally that we saw over the last 7 to 10 days is going to continue. Because as you may be aware from my previous videos, I've had a bearish view since March the 18th, but the bearish number was since 6,650. So this is where we started seeing chop at that level. We saw all the technicals and most importantly the fundamentals out there were aligning for a plummet, for this to really start hammering down past the 6,200s right into the potential for 5,900. So I was expecting a major drop. The question now is, am I still expecting that? So there's two things I'm looking at. One, obviously the news. The news is manipulated, and the bad news comes out at certain times, good news comes out at certain times. But the biggest key is going to be in volume, to see where does the big volume sit. Wherever there's big volume, there's going to be a lot of chop, and by chop I mean the kind of trading activity, price negotiation going on. Just imagine a fruit market or something like that, a marketplace where there's a lot of trading activity at say lunchtime or whatever, where they've got a lot more customers, a lot more buying and selling going on. So prices can fluctuate based on that. And you'll see towards certain times in a typical marketplace, prices come down because they need to remove inventory. And it's exactly the same concept here in the financial markets as well, except you have to find who the players are. What are the hedge funds doing? What are the asset managers doing? What are the CTAs doing? And you have to kind of piece that jigsaw together if you haven't got Bloomberg, which I don't have. And I've used it many times, so I kind of know what I'm looking for, and I piece together and model all the data, free data sets out there available to the public. And I model that, and then I get like dashboards, like for example, let's take a screenshot here. I will then create, I mean, this is just one piece of the dashboard, but it shows me where the stress is right now in the market. So let's start with this. Let's start with hedge fund stress. Right now, in fact, no, we'll come back to this. We're going to come back to this, right? Because right now I just want to look at volume, then we'll come back to the hedge fund stress and see where everything is, because I need to give you some wider context on that. So we can see here that prices run all the way for the last 10 to 12 days for many people with a bearish view, and those who took a position on that bearish view. It was horrible, myself included, but I was able to buy some or sell some volatility rather, so I did pause my losses, but it was not nice. The question now is this coming down? I don't want to sit there looking for a war and hoping people die so I make a quick buck. We're not supposed to think like that. So what we're looking for is the volume profiles, and to see whether or not where the volume's sitting at, and what is the possibility for the price to kind of fall through those volume nodes, right? So on a daily basis, we could see now we're kind of in the zone where prices around is being chopped around sort of 7,130. I mean, it's still high, right? So as soon as we get some rejections over about here, 7,150, if we get a few repeated rejections there, the price is going to chop into sort of 7,122, and then eventually it's going to fall straight through 7,100, because there was just no activity between sort of, where are we, 7,083 and 7,011. So we will see as soon as it kind of rejects this level here, 7,121, it's just going to plummet right down, maybe 30, 40 points plus, and then we're going to see some chop, a little bit of chop around here. But the panic might just keep pushing it down through these levels, and we're hoping at some point we see 7,850. We're hoping because of the news. Now, that's that. So on a daily basis, we see there is huge potential for this to happen. But if I do it on a more shorter term time frame, we have to see that that story is consistent, that volume story. And we can also see it here. If I get those volumes, those candles in range, we can see around the sort of, we're currently in the 7,140 mark, maybe 7,150. We're seeing some negotiation go on around here. If it comes through, we should fall through 7,098 and come into the 7,070 mark, where there's going to be a lot more activity going on. So I expect, hopefully, if we get some rejections, I expect that to go down here. But now here's the issue. Here's the issue. Are we going to get that price rejection? Why did the price go up in the first place? And why is it not just going to continue? So here's the issue, right? Let's get you a snapshot of what was happening with the hedge funds last week. Let's show you this. Now, here's something I missed. And had I been alive to the hedge fund activity, I would never have made this prediction about things falling, because hedge funds have been short 21% of the total open interest over the last kind of 2-3 weeks or so. Okay, for context, this is in the 90th percentile of the amount that has been shorted. Is it the word shorted? The amount that they've gone short over the last 5 years. So this is one of the biggest shorts. In summary, this we are at one of the biggest shorts in the last 5 years that hedge funds have been taking. And we need to understand why have they taken those positions, because obviously they've got negative sentiment out there. CPI is coming out a little better for them. That's hurt them a bit. They're looking for bad news on the war. So there's negative sentiment, and that's why they've taken these short positions. Hedge funds are not stupid, but what's been happening because of the positive sentiment on the war over the last 3-4 weeks, we have seen. Let's get another quick snapshot of my dashboard here. We have seen that asset managers have consumed a lot of that short demand. And asset managers don't have a tactical position in this world of hedging and whatnot. So they're going to act upon the demand of their clients, whether that's retail or whether it's pension funds or whoever. They're just going to act on that and take exposures. So they have just simply mopped everything up. So what does this all mean? It means that hedge funds right now, let's see if I can find this we need to understand, hey, hedge funds, how are your margin calls looking? Are you going to get a call from your prime brokers in the coming days saying, listen, you better close up shop or you better pay up? And what we can see here is that there is still margin stress of 114%. So they need to get this down to 50%. Right? They need to. The question now is, did they do this after Tuesday last week? Because we only have data up to the 14th of April. So we have to ask, have they done this? Have they actually reduced their exposures in that time? Now, I've got other data here that proves that they are actually on the down. They are still in the process of closing this. So we have two arguments. One argument that the volume profile says that there's a little bit of chop, but we have potential air pockets and downside. The other argument is that the hedge funds are still stressed. They've still got margins. They've still got uncovered positions, and they need to cover those. If they have to cover, then the price is likely to go up if the demand is there. If the demand is not there and they're covering at these kind of levels, the price is going to start plummeting because because they because there's no more demand at the top level. Sorry, my eyes have gone somewhere else. Yeah, because there's not going to be much demand at the higher levels. That's why the price is going to start moving down and lower. So this is what we're looking at. There's two arguments here. The question is, we're a bit blind to data over the last few days because we don't know what the hedge funds have done, but I've got 114% margin stress here according to my models, and the models are quite comprehensive. If you need me to publish these, please let me know. I'll find maybe a Patreon or something like this, and I'll start publishing the dashboard up there, and you can see what I'm looking at from the hedge fund exposure perspective. So now we are nearly 3 hours into the session, and you could see the volume is still hovering around the 7142, but there is more acceptance lower than that 7142 into this 7135 sort of mark here. So this is where we're seeing a lot of the trading activity take place. There was a few tests above that. The price was rejected. Buyers didn't come in, so it's come back down. So I think the reason it's holding up is still that there is still some short covering going on by the hedge funds, and slowly but surely they're unwinding in the background. We'll find out this Friday the 25th, and I'll report that data as well. We're going to be seeing them covering, but the trend seems to be, the bias seems to be on the downside. So what I expect, or what I hope to see, is that it may test this level once more, and then you're going to get that rejection again. It's going to come back down and hopefully just start falling through the floor after 7112, then down to 7100, and then there'll be a lot of testing going on around here. This may last a couple of days in this kind of 7062 area, because we need to understand the sentiment of the US war on Iran. So we just need to understand that sentiment and see where that's going. But I think that will be decided in these kind of levels, above 7,000 for sure, but around these levels. If we zoom in further, let's just see where this is in the medium term, because as you know, I'm going to repeat again and again that I have a very bearish outlook for the rest of the year. I think this whole rise has just thrown a lot of investors out, and it was just totally unexpected that there'll be that much shorts in the background. But then it begs the question, it's almost obvious that there would have been shorts because there's a war going on and the economy is not in the best health. So so yeah, let's see this level here. This is the next one, as I've mentioned, 7097, which I think we're getting right, just below, in fact it was 7110 right here. So I think we're going to see that today, and then after that, if these air pockets don't fill up, it's just going to come straight down, um, and then hopefully we'll see it go even as far down as 6890 by the end of the week. So that's the target by the end of the week. I'm not taking a position on this because my position is from here. 661, 6650 is where I'm at. Um, but as I mentioned, I have purchased some calls to protect and pause the losses from about sort of 800-ish or thereabouts. So I'm in the money on those, but it's not a nice position to be in, to have to manage losses. So I'm just looking for that excuse whilst remaining objective with the truth. And the truth is that the volume here is thinning out considerably. Although this level here of kind of like 7060 is also quite thick. So we'll keep an eye on that. The other thing to note is that we are quite overextended beyond the 20 moving average, so there is a lot of strength beyond that, but even that reversion seems to be taking place. There is a bit of a flat line appearing, so the range of motion towards the top is certainly peaking, but we'll know that by the end of today.